Hello, everyone, and welcome back to Trading Simplified. This is the part of the show where, once again, I'm amazed at the number of shows we've done so far and how fast it's going. This is our 20th episode. So, what are we talking about? Well, I want to keep talking about those traits of successful traders. It's kind of interesting. A lot of those traits dovetail in to what's happening in the markets, and we'll get to that in just one second. So, I think the elephant or the bear in this case in the room is the market itself. So I do want to talk a little bit about that. And I don't want to pour any salt in anyone's wounds, but if you listen to what I'm saying, the next time, when, not if, this happens, you'll be a little bit better prepared. No, by the way, I do take requests. When we first started the show, we got flooded with a bunch of questions. I don't know if we did a good job answering all those or what, but we haven't seen any questions in a while. So feel free to shoot us some questions. Here's my contact info. If you want the slides from this show, go to davelandry.com/StockCharts. If you need to get in touch with me, go to davelandry.com/contact. If you're watching a live show, give me about an hour or so to get the slides up because you'll end up getting nothing new right away. So the big question I'm getting right now is, well, what do I do with X, Y, Z? And my answer is always the same. What was your original plan? Where were you going to get out? Not if you're wrong, but when you're wrong. And the point is, and not to pour any salt in any wounds, obviously you didn't have one. And I saw on the internet a while back, it said, "Oh, you middle-aged guys, stop quoting Sun Tzu." But sometimes it's hard not to. And the Sun Tzu quote comes to mind: "In times of peace, plan for war." And he says just the opposite too. But when things are going swimmingly, just remember that sooner or later they won't be, and you need to have an exit plan in mind. As I often say, and will walk you through in just one second, all trades eventually end badly. If you're a trend follower, you're going to give up some of that trend in the end, or the trade just flat out doesn't work. And sometimes you'll get something somewhere in between. So you have to have a solid money management plan in place. Go back and watch one of the earlier shows that we've done where I talked about money management. If you want to do a deep dive on that, I could certainly give you a lot more information. So let's take a look at Apple because that's one of those popular stocks that everybody and their brother owns. And I'm getting quite a few questions on Apple. Now, let me just show you what's happening with Apple. We have a bow tie down, meaning that the 10 simple, the 20 exponential, and the 30 exponential have all come together and then spread out from uptrend proper order. Notice that the 10 was above the 20, was above the 30 for a long, long, long time. And then on this recent slide, they flip-flopped, suggesting a possible change in trend. Now, according to the rules of the setup, and we did talk about bow ties in one of the earlier shows, so go back in and watch that too. Borrowing a line from Greg Morris, just don't operate heavy machinery afterwards. So technically, we'd have a sell below this low here around 277. Slightly more aggressive sell would be here up around 285 or so below yesterday's low. Now, I wanted to show you the sell signal in Apple because it's the same sell signal in the overall market, which we're going to look at in just a few minutes. And pretty much 99% of all tech stocks, and maybe even 99% of all stocks for that matter. So Apple could be in a little bit of trouble. So have an uncle point in mind. In reality, I can't imagine that you'd have a stop way down here, somewhere in the 250s or so, and would have survived this massive correction. So the point I'm trying to make here is, one, there's a sell signal here and a plethora of other stocks, and two, don't wait for a sell signal though, because by the time that sell signal sets up, you could be in a lot of trouble. So you need to have an exit in mind. Now, some people bought Apple a long, long, long time ago. It's like, well, okay, you're 200-300 points in the money on this thing. Just bump that stop to where you're willing to give up so many points, and then if you get knocked out, you get knocked out. So be it. As Greg Morris once said, whipsaws are frustrating. In other words, sometimes you'll get knocked out, and then what happens? The trend resumes without you. Whipsaws are frustrating, but bear markets are devastating. So you have to have some sort of exit plan in mind. And that goes for the overall market too, for the investor, so to speak, in general. I recently did a little update. I would encourage you to read it on my website at davelandry.com. It's on the homepage right now. And it's an update on where we were, or where we are, I should say, going back a couple days. And in that, I discussed the fact that you have to have some sort of plan in place where you're going to get out of the market. And right now, everybody's calling me up, freaking out because they don't know what to do. Well, you need to have that plan in place long ahead of time. Now, let me just show you a simple little system here. And I think we talked about this a while back. We talked about market timing. So what we have here, and the people, the good folks over at StockCharts.com are very proactive and accommodating. And so they hooked me up with a programmer, and I've just been kind of busy. I haven't worked with him much lately, but he did get a few things out that are pretty neat. And I'm not sure when the release is going to be on this, if they're waiting for me or what, but this is pretty cool from what I've seen so far. And you'll see in one of my earlier shows, I showed the exact same type of indicators, which I created in another package. But now these are available in StockCharts, and I'll find out when they're going to be released. But what I'm measuring in the bottom window, that green wedge you see, is the number of days of Landry light, meaning that the lows are greater than moving average. And it's not counting the magnitude or anything or how far away it is from moving average, but the number of days that it goes without touching that moving average. And just from longer term research, after about 100 weeks, this is the weekly chart, you tend to see some sort of correction down. Now, I wouldn't try to time the market just off of that. But you can see here, this count resets to 0 whenever you have an intersection of that line. And I think this is going to be very useful to help you guys find trends and stay in trends, this daylight indicator, or Landry light as I now call it. And you can see, once again, you can see we had Landry light for quite a while, and then what happens when you touch the moving average, it goes back to 0. And then when the highs are less than the moving average, and this moving average, we're using a 50-week moving average, which I've discovered is pretty good for market timing. But when the highs go below, you end up with a negative count. Okay, so it would be minus 10 or 11, whatever the case is. And then that resets itself when you go back up. And then again, as you go through the trend, every time it hits the moving average, it resets back to 0. Now, the bottom of the chart is how far away from the 50-week closing high we are. So let's take a look at that. So I drew a line at 10%. 10% seems to be a pretty good line for market timing. My thinking is, if a market is going to lose half of its value, or 50% of its value, it's going to lose 10% first. Okay, so just some technical analysis 101. So I came up with an exit strategy of, if the market is greater than 10% away from its 50-week closing high, and the close is less than the 50-day simple moving average. So if you look at the bottom chart here, you can see we were more than 10% away from the 50-week closing high, and then we also closed below the 50-week moving average. Now, you could argue that this was a bit of a whipsaw signal, but the market did have about another, I think, 11% drop, if memory serves. We'll take a look at the spreadsheet in just 1 second from that. And you could see that the buy signal is a little bit more complex. We're looking for the market to be within 90% of its 50-week 50-week closing high, or greater. In other words, less than 10% away from its 50-week closing high. It's another way of putting it, said alternatively. And we're looking for 2 weeks of Landry light. And that just simply means the 2 lows are greater than the moving average. So that was the last buy signal there. And we'll take a look at the spreadsheet. So if you look down right here, you could see on March 1st, 2019, that was the last time it bought back in. And then we had an exit last week on the 27th. So the question mark for the diaper change, and the diaper change is how much further the market drops after the signal. So when I came up with this, I wanted to obviously beat, buy, and hold, but I was more concerned with avoiding diaper change moments. So let's say you're long a market forever and you come into 2008, you're thinking, yeah, I think I'm going to retire. I got about $1 million or whatever in my 401k or my retirement or whatever. And then you lose half of your retirement over the next year or so. Well, your lifestyle has changed quite a bit, and you might be faced with the alternative of continuing to work and hope, and I know I should never use the word hope, but hope that the market comes back. Now, if you read the aforementioned column, I point out that sometimes a market will go 25 years or more without making a new high. And a lot of people don't believe that, but all you have to do is go in and look at the charts. And that's the other thing, too. You members of StockCharts.com, you have an advantage over the general public because you can learn how to read charts and go in and look at things and say, hey, you know what? Dave's right. This market took 25 years to make new highs. And also, it loses half of its value fairly often. That's happened twice in my lifetime. As I also wrote in the article, every asset class, and I don't know who said this first, but every asset class at some point in your lifetime will lose half of its value. And I can think back to real estate, gold, silver, and twice the stock market so far in my career has lost half of its value. Now, this last little slide that we talked about, which you could argue was a bit of a whipsaw, the market did drop another 11%. So let's say you did have that $1 million in the market. Well, you would have avoided $110,000 additional loss. And the magnitude of that loss, or I should say the period of time that that loss occurred, was a very short period of time. So that would have been a very, very, very scary time. It's one thing to look at the chart and say, oh, yeah, I could have rode that out. But it's another thing to actually ride it out. So I would encourage you not necessarily take this system, which is free. By the way, I'm not selling a system. It's free. I'll give it to you. But I would take some sort of simple market timing and apply it to your longer term investments. Now, I don't believe there's any good long-term investments. Everything you have to be willing to stop out of when the music stops. You have to be willing to have a chair for when the music stops. So that's where we are. We got a major sell signal. And what's kind of fascinating is we had a daily signal that actually triggered after, well, it actually hasn't triggered yet. It's set up afterwards, the daily bow tie actually set up after the weekly timing system. So the question is, what do you do? Well, I would say follow the original plan. Now, again, I don't want to pour salt in the wounds, but if you didn't have an original plan, shame. Seriously, not to make light of a not so funny situation, just make sure that next time you have a plan in place. Let this be a learning example that markets sometimes go down. I know, you tell people markets go up and markets go down, they look at you like you pooed your pants. Kind of like the same look they give you if you walk into Starbucks, which I did years ago, and said, I'd like a cup of coffee, please. Anyway, now let's get back to the traits of traders. I want to pick up a little bit on where we left off. And we left off talking about acrasia and the importance of patience. Now, I've done complete presentations just on acrasia, so I'm going to try to get through this pretty quickly. Acrasia is a state of mind in which someone acts against their better judgment through the weakness of will. It's interesting that I learned about acrasia long after somebody emailed me and said, you know how Paul the Apostle says, I know not to do the wrong thing, but I do it anyway? Well, that's me. And this nice lady emailed me and told me that and quoted Paul and all. And I've actually done complete presentations on this. And there was actually a series of articles in Traders Magazine just based on this acrasia, although I didn't really know it was actually called that at the time. Okay, we're going to take a quick break. And when we come back, we're going to continue with our traits, starting with patience. Okay, when we left off, we were talking about traits of traders, and I think a big one is being patient. Just to kind of recap real quick from last week to get back up to speed, there's two forms of patience when it comes to trading. You have to have the patience to let the market come to you. And then once you're in, you have to have the patience for the market to move. Now, one of the things that I beat the dead horse on is Ed Sequota's quote, which I think was first written in Market Wizard. It says you have to separate intuition from intuition. And lately, I've been having a little, truth be told, been having some intuition trying to make things happen to A, recoup some money, and B, pick up some money on these intraday opening gap reversal trades. And that really hasn't worked out that well. So just to let you know, the reason I'm going off on this tangent is that I am not immune, and nobody's immune from a lot of these things, like trying to make something happen in the markets. Now, I'm a lot better at sticking with positions than I used to be. I just let the chips fall where they may. I have that stop in place and I let things go. A lot of people weren't patient enough. You go back and look at the AUY trade we talked about. That trade took months and months and months and months and months to finally get to the initial profit target and then eventually stopped out at a small profit. But I'd be willing to bet, based on the feedback that I've got from my clients, that most people probably exited long before then. And I see it happen all the time. Now, a really, really important trait when it comes to being a trader would be accountability. And last week, I touched upon briefly the two German traders that I met when I was speaking in Germany a few years back. One was successful and one wasn't. And the one that wasn't, he didn't have a different system. He had the same exact system as his good friend, but he simply wasn't following it. He was micromanaging himself out. If he would just simply say, look, Bob, assume, whatever, to his friend, he'd say, look, if you could just look over my shoulder, and when I go to do something wrong, make me explain why I'm doing it wrong. Hold me accountable for my actions. And that's all it would take. Now, a lot of us don't have the luxury of knowing a better trader that can hold us accountable. I'll be happy to do it for you if you want. But you might not necessarily need a better trader. You could possibly have your spouse, as we'll talk about in a few minutes, or significant other help you out to help you hold yourself accountable. Now, last week I talked about Robert Rotella. He said, you do not have to explain reasons to a higher official to escape censure. You have a far more harder task. You must instead justify your actions to yourself. There's no way to hide when trading because you always stand alone. And it can be a very lonely sport. Rotella, as I said last week, wrote a book, Elements of a Successful Trader. And I don't remember the book being earth-shattering to me, but I really did enjoy the psychology section. And I actually reread that section yesterday. And it's really good. I would urge you to get the book just for that. And like I said last week, he was going through a drawdown himself when he wrote it. So it's a lot more heartfelt. And I imagine he was doing some soul searching at the time. So the thing is, if you don't find yourself holding yourself accountable, would you be brave enough to hold someone else accountable? And this is a story I've told before. But I've had a client named Dr. John, and Dr. John's a pretty good trader. He does really well. He's a pretty good stock picker. He understands the money management. He gets it. He takes partial profits. He trails stops. Unfortunately, though, when he starts printing money in a nice momentum cycle, he gets a little careless with his stops. He starts taking trades he shouldn't, and then eventually he ends up in a bit of a downward spiral. Now, he's doing this with fairly small accounts based on his wealth, so he could easily sweep them under the rug, and I was fully aware of all this. And I said, well, Dr. John, why don't we do this? Why don't you say, look, I'm following this guy, Big Dave, and he's this momentum trader, and the only way to make money in the market is to capture a trend, and he trades trends, and you could be wrong quite a bit, so he always suggests using a stop, and then you might not be right big, so he suggests taking partial profits, and so on and so forth. To give her the whole trading plan, Show her what you're going to do before you do it, and then show her that you did what you said you were going to do. And his reply was kind of interesting. He said, "Oh no, that would end the marriage." So the point I'm trying to get to here is the beautiful thing about trading psychology and trading in general is if you have a little bit of experience, you know what you're doing wrong. And it's kind of like the old doctor joke, don't do that. So Dr. John knew he was doing the wrong thing, but he did it anyway. Kind of like Paul again. Doug Hershon, I like what he says, asking to be held accountable. Let me rewind that. Asking to be held accountable isn't a sign of weakness. It's an indication that you know yourself. Dr. John, obviously, it'd be really hard for him to get his wife involved in his trading. By the way, there was a study done by, it wasn't done by Montier, but he referenced the study. It might have been Galakovich, if memory serves, but you can Google it, where they took men and they got their wives involved in their trading, and the men's trading actually became better. But the flip side, when men got involved with the wife's trading actually got worse. So that's a little feather in the cap for you ladies out there. Now, it's been said before, a famous hedge fund manager got himself in trouble by saying that women are too emotional to trade. Well, I think that according to the study that Monty I referenced, I think that it's probably okay to be a little emotional because you're more likely to not let your ego get in the way. Now, another trait of good traders is that they are accepting. To you people out there who have children, you know that you get what you get and you don't throw a fit. You have to thank the market gods when you make a little profit on a trade and then get stopped out. And then let's say you get stopped out, then the market implodes. You have to thank the market gods that they got you out of a stinker trade. Now, if you, this is a farmer mystery chart. We got in here. We had initial profit target up here. This is CMRE. And then, by the way, in upcoming shows, I think I'm going to go through every single mystery chart, good, bad, and indifferent, and see how things turned out. But as you can see, hit the initial profit target. We were hoping, and I know it's the hope in one hand, and well, I won't go there. But anyway, we were hoping for a longer term trend, which never ensued. But we positioned ourselves for that potential unlimited gains, and you can see we got stopped out. So we were looking for 1% move, so or $1,000 per 100K. And then we got stopped out for about a $300 profit on the remainder. So that's about $1,300. And you add in, there was a little small dividend in there. It came to about 65 bucks per shares allocated on 100K. And so if you add all that up, that's about a 1.3% move. And that's pretty good, obviously. Or, as I say, better than a poke in the eye. But you'd be surprised at how many people get angry when that drawdown occurs, when that stock begins going against them and they get stopped out. They get angry because they gave up those open profits. Well, that comes back to the fact that you got to be really careful not to mentally monetize your profits. Okay. The next trait of successful traders is that they are gracious. They're willing to take what the market offers. And sometimes it doesn't offer anything, as you probably know if you're trading for more than a day. The other thing is they're agnostic. They don't try to justify why the market is moving. They don't try to interject logic or reasoning into the market. I often say, don't confuse the issue with facts. And I actually ended up buying that domain. It's a sickness of mine. I tend to buy up a bunch of domains that are worthless. But anyway, so as I often say, unless you're Bill Clinton, what is, a lot of you are too young to remember that. But Bill Clinton wanted to know what the definition of the word is. It's a Chewbacca theory for those of you who understand lawyer terms. So unless you're Bill Clinton, what is the price of the stock, the ask, is the lowest amount that someone will sell it to you. That's That's how much a stock costs. The value of the stock, the bid, is whatever someone will pay you for it. Okay. Now, good traders or planners, Mike Tyson, or some people say it was his trainer, once said, everyone has a plan until they get punched in the face. Well, guess what? We all got punched in the face last week and some of this week, right? But just one example here, we had a stock in the portfolio. The stop was at 1725, and somebody made a post that they exited this trade. Well, this trade might turn into a losing trade. I don't know. If I knew ahead of time, you'd never see my fat arse again, right? But I'm just going to follow a plan and see what happens. Let the chips fall where they may. In fact, what I'm going to do either in the weekend charts, which is on Thursdays, or in one of these shows, is I'm going to go in and look at my portfolio before the SHTF, before all this mess happened, and then look at it afterwards. And I hate to use the word hope, but my hope is through following the plan, one or two of these stocks remaining go on to make some fantastic gains. And it gives you yet another example of why you should follow the plan. But anyway, I had a client of mine, stop is down here, and he exited when the stock was a couple of points higher. It was nowhere near the stop. In fact, it took off like the next day or day after. So let's see what happens here, and we'll follow up on this. But the thing to realize is that micromanagement, that not following the plan by exiting early, will pay over the short term. You might luck out and have a market like we have now where you got out right before it tumbles. But longer term, you're going to miss the occasional home run, and those are important. I was talking about micromanagement, and another one of my clients pointed out that he got into this little silver stock based on a pullback or whatever he was trading, and he intended to follow along with the plan and hopefully have it turn into a longer term trend. But 2 days later, he gets out at a loss. What could have been a really nice trade turned into a losing trade by micromanaging. And I can give you tons and tons of examples of that. Good traders are disciplined, and discipline is a biggie. And the thing about trading that you really have to wrap your head around is trading and life is all about the micro. Part of the acrasia thing is it's like, okay, well, I'm just going to take this little trade. I know I shouldn't take it, or I'm just going to micromanage this one time. I know I should do it, but I'm going to do it anyway. Kind of like Paul again. Good traders are humble. I love this quote by Steve Pressfield. These scumbags out there that are selling these little trading systems allegedly and telling you all the money they make and everything really make me crazy. And he wrote, the counterfeit innovator is wildly self-confident and the real one is scared to death. Okay, we're just about out of time here. If you need to reach me, www.davelandry.com/contact. And if you want the slides from this presentation, www.davelandry.com/StockCharts, all one word. Thank you, everybody, for watching, and may the trend be with you.